I would now like to hand the conference over to your speaker, Mr. Rahul Jain. Thank you. Please go ahead.
Thanks, Raf. Hello, everyone. A very warm welcome to you all on this call that we have hosted with the senior management of HDFC Bank. This is Rahul Jain, and I'll be your host for this call today. From HDFC Bank today, we have Jagadeesan. He's MD and CEO Designate, and currently the Group Head and Strategic Change Agent. He's joined by Srinivasan Vaidyanathan, who is the Chief Financial Officer of the bank. Parag, who is a Group Head Payments, Consumer Finance, Marketing and Digital Banking, and also Anjani Rathor, who is Group Head Digital Banking. And also would like to tell you, Anjani has just joined the bank in January of this year. Before we start the call, let me read out a customarily disclaimer. This call is strictly for the clients of Goldman Sachs only. This conversation is not intended for the media and is off the record. Participants will be removed from the call if they can't be properly identified. This call webcast is not for the purpose of sharing or receiving non-public or otherwise confidential information. Attendees are public side market participants who may not receive and should not request non-public or otherwise confidential information about issuer or securities or about the market for securities. The format of the call is interactive, and we will have question and answer session following the initial remarks by the management. With that, let me hand over the floor over to you, Sashi, on your initial remarks on two areas which I'm sure everybody would like to hear from you. Number one is key area to focus on for you in the near to medium term, apart from COVID. Number two, the bank has been fairly advanced in terms of digital. So what is the next transformational change that you and your team is working on? And then perhaps we can go to Parag and Anjani for the remarks on the recent trends in digital journey across different business segments, including cards and merchant acquisition. And last but not the least, to Srini for his remarks on some of the latest trends in the financial markets. With that, over to you. Thank you so much.
Thank you, Rahul. Good evening, friends. It is a very unprecedented time wherein we're being under lockdown or on a semi-lockdown, not just in India but across the globe for such a long time. There have been parts of the economy which have started to sort of come up, and there are still parts of the economy which is still yet to open up or under a little bit of a distress. I guess, we really do not have a view as to when this pandemic is going to be flattened, at least in India. There are various views about that, but I guess normalcy in terms of return, in terms of economic activity, in terms of the travel constraints that are there will probably come about only post, maybe November, December, etc. That's the view that we have at this juncture. But in the meantime, we believe that so as a result of this, the first half of the year, I think you can virtually write off in terms of economic activity and growth. Willy-nilly, of course, it's quite natural that there is a negative degrowth or negative growth is what one would expect for the Indian economy, and probably that may be the case across the globe as well. But we do hope that once the economy were to sort of open up completely, we should see pent-up demand and pent-up economic activity, which should sort of spur growth, trying to, as much as possible, offset the first half degrowth. As there are some indicators that we are seeing now where we believe that the activity is picking up before. So indicators such as the card spends, which Parag will elaborate going forward, but we have started to see some amount of inching upwards to the 70% of pre-COVID levels as we speak. Hopefully by September, October, we should return to normalcy in terms of the spends, including some amount of discretionary spends as well. Of course, there are sectors and categories which will take a long time to pick up, i.e. in terms of the travel, which is sector, and maybe hospitality. These are a couple of sectors which will take even a longer time to pick up. But there are other sectors which has offset that, i.e. in terms of essentials, in terms of online education, in terms of medical, in terms of healthcare. I think these are sectors which we should see, which we are seeing a fair amount of growth in even during this period. We are also seeing consumption slowly returning back. We are seeing people, because of social distancing, probably rushing to buy more two-wheelers and smaller cars. So we are seeing the two-wheeler logins more or less reaching the pre-COVID levels. We are seeing the small auto car financing coming to roughly about 50% of the pre-COVID levels. But of course, in times of adversity, as we've seen in the past, I think demand for gold is pretty healthy. We are seeing demand for gold loans. We probably have reached an all-time high. We've also sort of seen loan against securities. A large part of people, I think we're seeing the maturity in the retail markets where a lot of our retail investors have continued to look at the markets at its low as an opportunity to buy, and probably they have been taking up loan against securities to reinvest in some of these requirements or for our personal contingencies as well. On the SME side, I think the government's program of providing government guarantee scheme for people with certain exposures beyond a certain turnover and beyond below a certain level threshold of exposures have helped us to provide the incremental funding. So this is virtually a government risk at a decent rate. So that is something that we have as an organization, as a company. We have captured that opportunity reasonably well. We have been first off the block, and we should be in a shooting distance to complete our program on that. As regards corporate, as we have seen in many other business cycles in the past, more pronounced in 2008, 2009 during the global financial crisis. I think the company having multiple levers for growth, and this is another demonstration of the same. We have been able to sort of capture opportunities which have come to our fold where the incremental risk is much lower than what our portfolio is. So I think because of our distribution, because of our funding capability, our capital position, I think we have been able to nibble a slightly higher share than anyone else in the market. This kind of a growth that we have seen over the last couple of quarters does not reflect that one can extrapolate that. We are also not saying that we are chasing growth. These are just opportunities and good opportunities that we have got over the last couple of quarters that we have sort of captured, but without diluting our risk standards for sure. The unsecured portfolio is another area that I'm sure all of you would be interested in. We still continue to be very cautious about it. We have not really opened up the policy for some time. We continue to patronize only the super Cat A companies and also some amount of the government employees for any incremental requirements on the unsecured retail loans. Credit cards I've talked about. So broadly, I think the journey and the business seems to be chugging along in a reasonable manner. We are, as you probably would know, we are reasonably sanguine about our funding capabilities. We have leveraged on our distribution. Even during the COVID period, I think our deposit growth has been, from a granular perspective, has been leading the way. We are happy as an organization, even though it's slightly on the higher side, to continue to have a higher liquidity coverage ratio, which is upwards of 150%. So the amount of surplus liquidity that the bank is holding in these times are extremely large and very comforting. Even though it may be a bit of a drag on the margins, I think the ability with the rates being what it is, we will be able to monetize the same as we need. Our asset quality continues to be, I think Srini and the team will sort of speak about that in detail in terms of where we stand on the asset quality, which you have already seen in the first quarter results, where we what is the position on our moratorium, what is the position on our check bounce rates on the non-moratorium cases, what is the position of our resolution rates on the non-moratorium cases, and on the low moratorium cases, what is the plan? Obviously, as much as possible, we may see a bit of a spike there, but is it going to be in a manageable band? I would think so, but more about that, I think Srini will cover. Now, coming to the focus areas that we are planning to do, the good part is that we've had very clear crystal strategies that we had as a team led by Mr. Puri sort of spelt about over the last couple of years, and all these strategies are no more a bird in the sky, but all implemented and in place. All that is required is to scale up, which is what we're expecting in the next 2 to 3 years' time to reach a level of scale which will move the needle for us as growth engines for the future. A lot of these things I've already discussed, but I would like to sort of reposition these strategies in terms of priority. Our first priority is going to be on taking the bank, the digital 2.0 we've been talking about, to a different level. The objective is that we want to go to the next level in terms of providing a great customer experience, even if it means that we're going to disrupt ourselves, which is exactly what we are planning to do. If we will be collaborating with a lot of partners, whether for customer journeys, whether for providing a completely independent or a parallel stack, and whether it is in terms of collaborating with other partners and integrating our APIs or microservices on other platforms. We've been talking about this, but then you will see Parag and Anjani unveil this in slightly more detail. This is very close to our heart. This is something that we are quite excited about. And I think as we move along in about 6 to 9 months' time, you should start to see more or hear more about what we are planning to do on that particular front. The second part of it is on the payment strategy, which Parag will cover in detail. But we're very clear that we have had a great run in terms of ramping up our merchant acceptance points from 250,000 number of 2016 to about 2 million merchant acceptance points as we speak. I think as you know, our strategy is to capture the huge market opportunity of almost 50 million organized merchants in the country today. As a system, we have very limited penetration, and we want to be first off the block to capture that. As you know, it sort of not only helps in sort of giving us a fee income, but largely, merchant acquiring is normally a loss leader. So what salivates us to be in this particular space is two things. Number one, it complements our banking needs, because when we go to a merchant, we insist on getting his current account and his family accounts, which is what is our bread and butter for our businesses. In addition to that, a huge amount of data by virtue of being the market leader in this space, where almost about 40 to 50% of the volumes go through our systems, our payment systems. We have a fair amount of data which we sort of can monetize it at the right time. So that one, I think Parag will unveil as to what his plans are. The third aspect of it is on the semi-urban and rural parts of our geography strategy. This is a virgin market. there is a huge amount of population which is there. It's about almost 70% of India lives there. You probably would have seen the recent statistics on what is the per capita GDP that is now clocking in that particular geography. It's now upwards of $2,000. As you probably would know, that's an inflection point whereby we should see the demand for financial services products really move up geometrically. We have been in this space for some time now. Today, about 50% of our distribution is in the semi-urban and rural parts of the country. We're also sort of supplementing it more and more partnerships in that particular geography with a lot of business partners and correspondents. As you know, we have tied up with the Government of India's Common Service Center program. We already have about 100,000 such business facilitators or common service centers as partners with the bank. We follow a hub and spoke model so that we're able to leverage on this particular platform to be able to distribute more of our products. So this is going to be very important for us, and we're going to step up our pedal in this geography, riding on various platforms and distribution points without compromising any of our risk management. Today, we are by far the largest, distributor of assets of products on the asset side of the balance sheet. 17 to 18% of the business on an overall basis comes out of that. When you look at only the pure retail and SME businesses, it's just about 30%. So we want to really ramp this up over the next 3 to 5 years, and this is going to be a big game changer for us. The fifth part of the strategy, which we have spoken about, which again Anjani will elaborate, is on the engagement side of the business. We realize that the more you engage with customers, we can really juice out a lot of relationships, and this is something that is a proven track record that we have. So we have almost about 55 million customers today. We add almost about 5 to 6 million customers every year. With such a large customer base, you need a large army of workforce to be able to engage with all these customers. So apart from the branch distribution channel where we have dedicated personal bankers and relationship managers, which manage about 4 million customers as we speak, we also sort of floated another 3,500 virtual or remote RMs who connect and engage with 6 million customers, on a remote or a virtual basis. Because we have slightly enhanced and digital platforms where we can serve products and services on an assisted manner, we want to now, and we have seen a reasonable amount of success ever since we launched this program a couple of years ago. We plan to really ramp this up going forward as well. More about that, Anjani will talk about it. So these are some of the areas that we are focusing on. There's nothing new. The time has come when we need to scale it up. We are well positioned about the kind of platform that is being set by Mr. Puri and team over the last many years. I think we are fortunate. So I think, the market opportunity or the runway for the bank to grow faster and higher from here without compromising on any of our risk standards or compliance standards is there. So we are quite excited about the future, and we shall be in touch with you as we go along. Let me pause here to hand over to discuss more about the payment part of the business, Anjani for the digital part of the business, and Srini to talk about some aspects of the asset quality as well. Parag, over to you.
Okay. Yeah. Thanks, Shashi. So I'll take. Hello, am I audible?
Yes, Parag.
Yes. Okay, fine. Great. Right. So I'll take it in 2-3 parts, and I'll take off from where sort of Shashi started out. So as you all know, both on the issuing and acquiring side, the credit card side specifically, and on the acquiring side, we're market leaders. On the issuing side specifically, we have approximately 1/3 the spend of the credit card industry in the market, and of course on the book we have a much higher share. Our strategy continues to be primarily, and I'll talk about why, to be primarily an in-house or internal customer-led strategy, with approximately 75 to 80% of our share, both on the portfolio side and on the incremental side, focused on internal bank customers, which means bank customers who have at least one relationship. Typically, it would be a liability relationship with the bank, and about 20 or 22% which comes from new to bank customers. And that's been the hallmark or consistent approach which we've done over the last 15 odd years. It's given us significant benefit. One is in terms of our ability to know the customer even before we card the customer, because we have a view and visibility on his balances and his liability behavior. It's easier to reach out to the customer because there's a relationship, and some form or the other these customers are being touched either by a physical body or by a telecalling sort of unit. Okay, it's also given us significant benefits in terms of better underwriting, the ability to give better limits, giving him the right product so that customers understand it and use the product, and at the same time also gives us significant leeway in terms of a good, solid, low delinquency portfolio, and this has helped us clearly in the long run. So the internal strategy of the bank will continue, as Shashi did mention, that our acquisition engine on the liability side and the asset side continues to sort of grow month on month, and we incrementally source a significant large number of accounts for the bank. As you can see from the numbers, we've got about 14 odd million cards right now, so there is significant headroom in terms of even focusing even more on the internal customer base. And as our acquisition engine on the liability side ramps up, I think that incremental opportunity continues. So one part of the credit card strategy, it's only one part of it, which is continue bullish and aggressive with the same kind of quality parameters, acquisition, 75-80% internal customers, and 20-25% would continue to be open market customers. And even in that open market customers, let me say, the focus is more on what we call this premium and the super premium cards, because that is where we really focus on the top cream of customers who do not have a relationship with us. Currently, they enter the bank through a relationship of the card because they see value in the card proposition, and subsequently we upsell and cross-sell to the same set of super premium customers to get them into the higher band of our liability relationships, the managed programs and the private banking programs. So that continues, and we continue growing at the same pace. That's one leg of the growth area in the card space. The second leg is a lot of focus, significant focus on what we call portfolio management, but effectively saying we look at sourcing of the card just as a means to cherry pick the right kind of customer, but it's a cost. Our real engagement starts the day you sort of source the card, and so from day zero onwards, we have a very robust and intense step-by-step process of onboarding the customer, engaging with the customer in the first 30 days, 60 days, 90 days, ensuring that activation levels of the card, engagement levels on the card are maximized in the first 90 days of the life of the program, and then subsequently post that on a micro-segmented basis. We use a combination of a strengths on the acquiring side. I'll talk about that a little later. Okay, our significant focus on customer analytics, understanding customer behavior across the bank, to drive significant engagement with the customers to ensure that he keeps on using the card. In fact, some of the metrics internally which we use to drive or to measure activation are reasonably, how I would say, strict. Okay, typically the industry would look at active cards on the basis of one transaction in 30 days or 90 days. We drive a much more higher benchmark in terms of looking at more number of transactions within the first 30 days or on an active 30 basis, as we call it. And so there's intense focus because the engagement, the loyalty, the continuity, and the deepening of the relationship happens when there's a significant focus on engagement. So that's the other core leg of driving much higher activation, much higher spend per card, and continued engagement and lower attrition on our card base. So that's one clear key factor which we do. Coming to the acquiring side, and I'm talking of basics, and then I'll come to the level where we sort of how we're tackling the current scenario in the marketplace. On the acquiring side too, we're market leaders and we're a full suite acquirer in the sense that we do physical merchants, we do online merchants, we do digital merchants. We're a full suite acquirer in the sense that our philosophy and approach to the merchant is that we should equip every merchant with all the possible acceptance methods so that any customer who walks into that merchant or clicks on the merchant's website is able to pay with any payment form which he has available, which means we not just acquire card networks, and we acquire all the card networks, but we also acquire UPI, we also acquire the QR code, the Aadhaar, the wallets, etc. And our approach to the merchants is simply put, it's a platform approach. We approach the merchant saying that here is a platform. That platform is called the Smart Hub platform, which enables in a simple manner, in a simple plug-and-play manner, either on his POS device or on the payment gateway or through the merchant app which we have, the ability to accept all forms of payment. There are other value-added services also, which I'll talk about just a little bit later. But that's essentially the Smart Hub platform. Along with that, as Shashi mentioned, we enter into a relationship with the merchant, if it's a new-to-bank merchant, or if it's an existing merchant with a current account already, we enable the payment layer on top of it. And we deepen the relationship subsequently by demanding the current account relationship. And as mentioned before, that gives a wholesome picture to the merchant acquiring relationship which we've just entered into. Because it's a transactional business, we get a wealth of information on the types of transaction he does, the ticket sizes, the cash flows, the inward-outward remittances which the merchant does, and using that as a basis of not just taking his balances but also his cash flows and the kind of transaction flows, we're able to much more focused and sharper manner underwrite that merchant, and therefore we, beyond the payment and the liability relationship which we have gained, we also add on top of that layer a lending relationship. The lending could be the secured lending or collateralized lending, which he may require from time to time, or the business loan type working capital or short-term loan or short-term lending loans which the merchant may require at any point in time to run his business. That's the way we look at the acquiring business. Therefore, it's a holistic approach from a bank point of view. We enter in through payments, acquire the liability relationship for him, his business, him as a consumer and his family, and overlay that with a lending relationship. And in that sense, therefore, it's a full suite banking solution which we offer, and not just a merchant acquiring relationship. As mentioned, the merchant acquiring business in India, ecosystem issue for India, is a very thin margin business. But the way we've looked at this business is the acquiring business is extremely strategic for us, for the bank and for the retail business, in that it primarily lays the foundation or the railroad, if I may call so, for accepting payments across the length and breadth of India in the physical space and on the online space. It's a railroad to move money from X point to Y point. We are leaders, and we process approximately 48 to 50% of the electronic volumes which ride on the HDFC Bank acquiring network, and so therefore we gain a huge amount of data and we see a huge amount of commerce flow happening. And in that way we bind the relationship. Now, these are the two sets which I talked about. There's the issuing side and the acquiring side. There's a third layer which we overlay on top of that, and this, we believe, while it binds the two issuing and the acquiring sides together, actually forms the crux of our go-to-market strategy. In that, I mentioned the word platformification or platform approach. We have actually created and in the process of strengthening that thing by actually now taking it to the next step of level of calling it an ecosystem approach. What do I mean by that? There are essentially two ecosystems which we are building and putting together. We are currently in the process of strengthening that. One side of the ecosystem which we have built is focused on the consumer. Very simply put, we have a platform, as you all know, SmartBuy. SmartBuy is on one side I can describe it as a storefront which hosts several merchants on the storefront, and consumers can come to the SmartBuy portal. It's also available on the mobile and transact, consume, spend, pay for all typically day-to-day routine monthly expenses or expenditures which the customer would do, which means he can do a simple top-up, he can book an airline ticket, he can book a hotel, he can book bus rides, he can do shopping on Amazon and Flipkart, and several other services which he can do. Okay, so that's the storefront which we have created. But how is it an ecosystem for the consumer, and how do we leverage that? So one side of the power of the ecosystem is that we offer to our large merchant network, the acquiring side of the business which I talked about, the opportunity to address our 14 million credit card customers and our 30 million, close to 30 million debit card customers. Effectively, it covers the bulk of the bank, and offer preferential deals and offers to the customer. To the customer, we say, come here to SmartBuy, spend, buy, purchase, transact, etc., because you'll get a better deal than what is probably available in the anywhere else in the marketplace. And so therefore, we've actually created, in a sense, a virtuous ecosystem or a virtuous closed user group, which says, to the merchant, I offer him access to my large customer base. He sees increased footfall. In lieu of that increased footfall, which means increased top line to him, he's willing to offer additional benefits, if you may call so, offers to the large set of HDFC Bank customers. The bank customers see better benefit because they see a good deal compared to anywhere else available. And it therefore becomes a virtuous cycle whereby creating a strong reason for the customer to keep on coming back again and again and again to this ecosystem. He uses the HDFC Bank issued instrument, the credit or the debit card. The merchants see increased footfall and hence increased top line, and therefore we see customers keeping on coming back. We've taken, so this is the SmartBuy platform or the ecosystem, if you may call so, which is consumer focused. We took that even further, one step further, by creating another platform over and above the SmartBuy platform called the Treats platform. This Treats platform essentially focuses on some of the online merchants, but much more on the large set of physical merchants, where we said that the same principle as SmartBuy, the Treats platform is an opportunity for merchants to sort of come onto that platform, offer great deals and offers to our customers. Customers come to the Treats platform and avail of benefits which they would otherwise not get. And we've actually therefore taken the SmartBuy platform, which is essentially an online platform, to the physical merchants, and thereby give the opportunity for even physical merchants to participate and access a larger number of HDFC Bank customers. So that's the ecosystem which we've created for the customer side. On the merchant side, the other ecosystem which we're creating is, so as I said, the benefit of this first ecosystem plays into the merchant because he sees access to customers. At the same time, and a lot of questions have been asked to me over the last 6-8 months as to how are we sort of going to compete in this hugely competitive world where you have a large number of players investing in the merchant space. Very simple. I talked to you about our approach of entry through payments, acquire the liability relationship of the customer, his business, his family, and of course overlay that on assets. We've gone now one step further in that we are now created value-added services which are overlaid on top of the core payment ecosystem which we've created for the merchants. What do I mean by value-added services? What if my payment service provider or my merchant acquirer, in this case HDFC Bank, walks to a merchant and says, "Hey, you've got 2,000 customers. Why don't you run your own loyalty program? You can decide whom you want to run to your customers, but today you may not have the wherewithal because you're a small merchant. Here in my app is a plugin wherein you can run your own loyalty for your customers, and you can pick and choose and do whatever you want. It has the capability for you to upload your database of customers in that. By mobile number, it has the ability for you to give differential offers depending on, say, whichever type of customer you would like to do. It has the ability to track the kind of spends which the customer has, and you could do multiple things. That's one example of what we call a loyalty program for merchants, which he can run for his customers. There's another value-added service we say that what we call the khata, or the book, which means we embed in our value-added services layer a program, it's a software program, API-based, which allows him to link his payments and the summary of his payments into his larger shop ledger or his business ledger, so that he gets one integrated view of not just his payments, but integrated that into his overall business. So it's like a sort of digital ledger book, which does all the reconciliation and accounting for him and gives him a one view of his entire business whenever he wants to do, all of them available on the mobile. The third kind of value-added services is, for example, in the lockdown, especially in the lockdown period, you have a large number of physical stores who have just been sort of laid bare because customers are not able to walk into shops. So we've enabled them through our through another value-added service of being able to extend two capabilities to his merchants. He can take a photograph or through his mobile phone of his product, load it into WhatsApp and send it to his customer base. That picture goes to all of his customers on their mobile phone. It goes with a link. The customer can then click on the link and say, yes, I would like to this, order the product, and click on the link, make the payment electronically, and the merchant would have to deliver the product, So the home delivery, enabling home delivery for many of the physical merchants was a big barrier. Okay, we've been able to do that in our value-added services list. There's a list of actually 8 or 10 additional value-add services which we're offering. Each of them are focused on different types of segments. So we've done micro-segmentation of the merchant layer. It could be a grocery store, a small grocery store. It could be a mini supermarket. It could be a medical store. It could be an electronics store, etc., and so on and so forth. And we've created value-added products for this. This completely enhances our overall plug-and-play one-box payment solution because it's now feeding into his own business model. A combination, therefore, and that's what we call the merchant ecosystem which we're building on. Layer it on it that we offer a very attractive business card proposition to these merchants. And through the business card proposition, merchants are able to pay for all their business expenses, pay for his bills, pay his vendors, etc. through the business card bill and through the business card. And on top of it, we're able to lend to him in small value loans through in a very simple fashion through the card network. So all in all, when we're talking about it, this second ecosystem which you're creating caters to the complete needs of that merchant, if you may call it so, or a self-employed. I talked about segments. It could be a doctor, it could be a dentist, it could be a chartered accountant. He gets a full-fledged payment solution which helps him buy, purchase, reconcile his entire business into his accounts, all from one service provider, which is HDFC Bank, and therefore our thrust into the merchant space is actually go for target a lot of new to bank and new to category merchants, you may call so, and thereby take our current merchant acquiring base, which is approximately a little lower than 2 million, which is covering all acceptance points, which is physical POS, payment gateway, and our merchant acquiring. We have aggressive plans on growing that merchant franchise. So So very clearly, we have aggressive plans on both the issuing side and the acquiring side, and I've explained to you how we've sort of attempted to link them together so that both sides see the advantage of the other side, and in a sense, it becomes a very large virtuous cycle, and it becomes almost like a closed user group, wherein each side sort of begets the other, and then therefore we're able to dominate and also ring fence this whole entire business which we have, and we continue to be dominant in this space. I'll pause here for a minute in case there are any questions, and then maybe subsequently, then if no, then maybe Anjani can take over in terms of the debit, in terms of digital space.
Thanks, Parag. Anjani, over to you.
Thank you. Good evening, and very nice to be talking to all of you for the first time here. Shashi very briefly alluded to Digital 2.0. I would, very briefly elaborate on what is exactly Digital 2.0 and what we are trying to do here. Digital 2.0 from our perspective is essentially divided into three different pillars. The first one is on digitizing our existing bank, where we are taking every customer journey and creating a new experience which is completely frictionless, zero-touch, contextual. Now, what does this mean? Let's take an example of opening a savings account. If you try and open a savings account today with HDFC Bank at any of the touch points, whether it is branch banking, anybody walks into a branch banking or just calls up a VRM, or you just call up a call center, you would get a simple link on your mobile phone, and as a customer, you will be able to open that link, get to a form, and complete that entire form yourself in a matter of few minutes. And while you are filling the form with your Aadhaar detail, your mobile number, your PAN card detail, at the end of it, you arrive at a point where you get to do your full KYC with one of the bank officers who is virtually available on a video conferencing. So a bank officer can do a full KYC for a customer who has just now filled details over a period of a few minutes. And then at the end of this transaction, we are able to open a full KYC savings account for a customer without the customer walking into a bank branch. So this is now possible. We are able to open many accounts like this, and customers are just loving it. If they are calling up branch banking, any of the agents, or virtually they are calling up the contact center, they are able to open accounts. Now this is just on savings account. Likewise, if you look at current account, it is also possible to transform the same journey. What used to take a few days earlier because of several back-end processes which used to take time, is now our customers are able to open a current account also in a matter of a few hours. So this is possible on every journey, whether it is on the liability side, on the asset side, or on the cards side. Each of the journey is being completely reimagined, and the experience is getting changed end to end. This is being done not just for our existing to bank customers, but also new to bank customers. So all the touch points where we have customers coming to the bank, this new customer experience is now visible. It's a journey, and we are progressing and transforming each of the journeys as we go. So that's the first part of the digitization and Digital 2.0. The second part of Digital 2.0 is actually places where customers go for their lifestyle needs. So in one case...
Mr. Anjani, you're
Hello?
now back in the room. Thank you.
Thank you so much. Sorry for that break in between. That was the first part of the journey. And the second part of Digital 2.0 is essentially where customers go for their lifestyle needs. So somebody goes to an online shopping mall to buy a refrigerator or buying any other equipment. And we want the bank to be present at each of these digital properties across the country. So whether it is run by a big tech or by a small fintech, if the experience is great, we want banking to be present there. And with the help of our APIs, we are able to extend our liabilities, our assets, as well as our card products and various payment experiences at these properties. So today it is possible that you go and do a shopping at any of the online shopping malls, and while you're checking out, you have the ability to pay with your card. At the same time, there will be an ask saying that would you like to convert this into an EMI? And if you are an HDFC bank customer, you can just tap in and convert your transaction into an EMI. Now, these kind of experiences are possible now with the help of APIs, and we are extending this very aggressively across various digital properties where customers go for their lifestyle needs, but bank is following them. And this is not just only at online, but even at offline, so at some of the car dealerships, at few of the retail stores, very similar experiences available when you are trying to check out. And the third piece of Digital 2.0 is essentially around ecosystems. Parag referred to Smart Buy and PayZap and a merchant ecosystem that has been created. But we are looking at transforming the experience at these ecosystems in a very different manner. These will not be a conventional and a traditional experience that we've seen so far. These are very unbanked experience where a customer is going to very intuitively, is coming to look at products and services. A customer is looking for, let's say, flipping through various cars, wants to buy a four-wheeler, is scanning, etc. And as a part of that entire journey, banking is very subtly present there, and we are enabling those kind of experiences across various platforms. So these three things put together is reimagining banking for us, and you are going to see a lot of this unfold over the course of next few months as we deploy this in the market. And lastly, we also have a virtual relationship management channel, which Shashi referred to in the beginning, where our customers are being managed by relationship managers who virtually connect with these customers on a regular basis. We are seeing very good traction. Even during COVID times, we've been able to connect with these customers very often, and our right party contact has not gotten impacted. And as a result, we are seeing some of these businesses have not really seen a dip as much as some of the physical brick and mortar side would have seen. So this has been very encouraging, and we are seeing a good lift coming up as we go forward. So that's all from our side here. Thank you.
Okay. Thank you, Anjani. This is Srini here. What I will do is, as Shashi alluded to at the beginning, I'll give you some color on the portfolio quality, the portfolio situation, so that after that we'll get it back to Rahul. Three things I want to give as a context first, right, before we jump into the quarter that we just concluded. The context is, which we articulated maybe 3 months ago, 4 months ago, we articulated this, but I want to recap so that it's fresh in the mind, right? One thing is that as we were entering COVID, our portfolio delinquency, the portfolio quality situation was stable to improving. Some were stable, some were improving. And that you need to keep in the context of what was happening in the macro situation in the country. As the macro situation, GDP was coming down to 4 and something, and lots of other activities were happening in the economy, our portfolio was stable to slightly improving as we entered into the COVID. So that's one context you need to keep in mind. The bank's portfolio was stable to improving as we were entering COVID. The second, two more things that we said at that time to keep in mind is, what is the kind of our positioning, our delinquency positioning compared to what the industry was, which we articulated in great deal of detail. I think it was in April where we came with a lot of data, which is, if you think about the industry delinquency for any particular product at 1, right? Depending on the product, we were anywhere between 0.4 to 0.7. So that's where our positioning was. If the industry delinquency was 1.0, our delinquency was anywhere between 0.4 to 0.7, depending on the product. So that tells you the relative condition of our portfolio as we were entering there. The third important thing that we gave is also about the credit score, right? Particularly on the retail front, and we'll talk about the wholesale front too. But on the retail front, the credit score that we said 750 and above, which is supposed to be excellent scores, when we look at the bureau and when we measure our credit score versus what the bureau, keep in mind the bureau scores is only one of the variable that we have. And in fact, we have our own scoring models, where we give scores to our customers, but we also use the bureau as another reference point. When we compare the 750 and above, compared to anybody else in the industry, we were at least 12 percentage points higher. Our customer base was 12 percentage points higher than anybody else, the nearest whoever was, right? So that's the kind of starting position that you need to have. On the wholesale front, we said that on the wholesale, our internal scoring, 4.3 on a scale of 1 to 10. We were at a 4.3. We continue to be around that level, 4.3. The incremental booking that we have grown significantly over a 2-3 quarter period, the incremental booking has been of a top quality. The 4.3 is equivalent to AA kind of, right? So which means the book is predominantly comprised of AAA, AA. That's what the book is. 4.3 is the average score on the wholesale front. So that's the context you need to have. And then in the context, the quarter that went by, our GNPA 1.36, pretty much close to, the average of the last 4 quarters, 5 quarters, if you see, is about 1.4. So very much in that ballpark, that's where we had our delinquency GNPA at 1.36. Our 1.36 included 30 basis points of acceleration. That means we looked at our portfolio, which is in the collection bucket, and we employed our models, analytical models. We have all the time our predictive models, which is the backbone of our collection strategy. So we employed that model to see what is it that we need to do. Should we wait for the delinquency to hit, to go past the threshold, say call this 90 days or something, and then recognize an NPA, or should we advance it? Should we get it ahead of time? Which is what we did. Our model showed that there is a bunch of these customers who are susceptible to getting into that NPA over a period of time, and we said let's advance them now, and that was about 30 basis points or so included in that 1.36, right? Otherwise, you're talking about 1.06 being the NPA, GNPA, but we accelerated and brought them in. That's something I wanted to mention. Then in terms of the provisions, specific provisions, right, which means on the GNPA, what is the provision? We did say that 2/3 of the provisions that we created in the quarter corresponds to that accelerated GNPA that we recognized, right? In addition to that, we also recognized about 1,000 crores or so of contingent provision. Contingent provision, as we call it, it's not meant for something. It is more an event can occur, not occur. Is not in terms of identifying to a particular thing, but making the balance sheet more resilient, right? And which we have done over a period of few quarters, if you recollect, and that aggregate amount at this moment we have is about 4,000 crores, right? We built a contingent provision to the extent of about 4,000 crores. We do have the floating provisions, which has been constant, and our coverage 149% or so, right? That's how we think about it. From a loss ratio point of view, across all the aspects, the credit loss ratio, specific or any kind of P&L charge, 154 basis points, right? That was the current quarter. Out of the 154 basis points, 73 basis points was this impact due to the accelerated charge that we took, accelerated NPA that we recognized, on which we took the charge. That's 73 basis points, and 40 basis points is consequent to the contingent provision, right? So that's the composition of the losses I want to mention. Then Sashi also alluded to the situation of how the book, as we were getting to the quarter, how did the book, how was it performing from a collections point of view, right? If you think about the check bounce as one of the kind of a criteria, as we were going through June, coming out of the COVID things in the April and May, we saw that the non-moratorium book, the check bounce, significantly better than the pre-COVID level, right? And how much better? About 10 to 20 basis points, depending on the product, whether it's a personal loan or auto loan or a two-wheeler loan or whatever, depending on the product. 10 to 20 percentage points better on the check bounce. That's what we saw in the portfolio on that side. Then in what enters the collection, what is in the collection pool and how we resolve the collection, we were, despite big cities, Mumbai, Chennai, Delhi, under lockdown, I wouldn't say broad-based lockdown, but selective containment zone lockdown. These are big cities, right? Still having things. Despite all of that, our collection resolution was anywhere between 85 to 90% of the pre-COVID levels. So as we were entering into June, that is the kind of level. So which gives an impression that things are getting to be normal. Not there yet. That's why it is 85 to 90%, but significantly better than what one would expect in this kind of scenario. That was our collection efficiency or the resolution that we can talk about. Right. The moratorium we talked about 9%, 9% is the moratorium. And with that, these are 3-4 things I wanted to mention on the credit quality. Rahul, with that, maybe I'll get it back to you and we can answer anything else.
Thank you, everyone, for the elaborate comments. Operator, can you please check if there are any questions? And while the queue gets built up, I can ask maybe 1 or 2 questions. So I have got one question, which is on the strategy. Sashi, perhaps for you, any thoughts on the medium-term strategy of the bank, and how do you seek to manage the rising competition from the tech companies and some of the incumbent players who are becoming fairly large in the retail business as well as e-commerce business? So that's question number 1.
Sure. Okay. So thank you, Rahul, for that question. As you know, we, as I mentioned, I think we have a clear roadmap of what we want to do over the next 3 to 5 years. As I said, we have our hands and plates full to whatever we have implemented or developed on a collective basis along with the management team in terms of strategy. All that has been implemented. We just need to scale up. Part of the strategy is on how do we deal with the platform players. I think you will see a large amount of collaboration that's coming about. Parag and Anjani will unveil it at the right time in terms of the kind of collaboration that we have with the tech platforms. We are not going to see that as a threat, but I think the kind of communication that now Parag and Anjani are having with the platform players, I think it's you will see a wonderful partnership on a symbiotic basis going forward. But what we are is, obviously, when we say that we would like to partner with them, what it means is we are also sort of building our own capabilities as well. Anjani did specify that 3 or 4 things that we are going to focus on. But there are a lot of other things that we are doing. We probably will unveil it maybe at the right appropriate time. But all I can say is that to be able to not only partner but also be a counter to any potential threat coming out of the platform players, we will be disrupting ourselves and probably having a parallel stack within the bank so that we are able to offer similar kind of a frictionless customer journeys that a platform player is able to provide for the banking needs. So this is something that it's in a very advanced stage, but it will be more appropriate for us to sort of unveil it at the appropriate time. But these are a lot of exciting things which is in play. We believe even whatever he has mentioned in terms of consumer journeys, even that we're also going to be partnering with a large, digital player on the global arena. So I guess I'm not too sure whether it's appropriate to tell the name, Anjani, but whatever it is, when we do unveil that in terms of the kind of new journeys for our existing staff that we're going to do, I think it will be a game changer for us, not just in the banking space, but even otherwise as well. So I think collaboration with the platform players, the fact that we will be, as a part of this journey, to be able to partner with them. We'll also be having new stacks to be able to provide frictionless journeys is something that's on the anvil in the, I wouldn't say what you call maybe 6 to 9 months. If it's a medium term, then so be it. That's a medium term journey.
Thanks, Shashi. Just another question before we open up the floor for Q&A. This is about the strategy that you talked about, which is more which is more in terms of scaling up what we have strategized so far. What does it mean for the cost-to-income ratios? Because I think we already managed to bring it down to late 30s, 37, 38%. In fact, last quarter was even lower. Where do we go from here after the business starts scaling up, or would you look to pass on some benefits to the customers?
Actually, the core cost to earnings continues to be at about 38%. Yeah, you're right, absolutely. We brought it down from 48% to 38% over a period of 8 to 10 years, which is in line with our vision and strategy. Even though the current recent quarter is about 35%, that's an aberration. That is something because a large portion of the variable expenses will not come in because of the fact that our retail businesses at the margin have been very tepid. But once retail starts to come in, you will see the cost to earnings hovering around the 38 to 39. But with the implementation of whatever we have set out in terms of scaling up of our strategies, which is already implemented, and then implementing the Digital 2.0, which will bring in even more straight-through processes, virtually zero human interventions, which will enable at the margin virtually near to zero cost. I think we should see what we had envisaged between Mr. Puri, Srini, myself in terms of glide path downwards in terms of cost to earnings to at least the mid-35s and over the 3 to mid-30s in terms of over the next 3 to 5 years is something that we are planning to as setting ourselves as a target. I think normally we don't give guidances, but this is one area that we believe we don't mind giving the guidance because we are sure to achieve that.
That's very helpful, Shashi. Raf, over to you.
Thank you so much. Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, you will need to press star and 1 on your telephone. Again, it's star and 1 if you wish to ask a question. And our first question comes from the line of Ruchit Puri from the Millennium. Ruchit, your line is now open.
Yeah, hi. Thank you. Thank you for taking the time, management. I really appreciate it and all the comments so far. I guess my question is regarding the restructuring scheme that has been announced by the RBI. I mean, I know it's early doors, but I wanted to get your thoughts on it, whether you're happy with it, or you think it could have been different or better in any way. If any early thoughts on what part of the book for you qualifies under that. And then I guess last point on the same is that do you think the 0 to 30-day policy is viable? I've heard that a lot of banks are asking for it to be extended to 60 days.
Right. I mean, on a broad basis, we believe that the restructuring to some extent is welcome in the circumstances that we are in, because we do have a lot of knowledge and feedback from set of customers who have the ability to run good business models, who are probably constrained by the lockdown during this period and both from a demand and a supply side constraints. I think providing that a bit of a relief for them to resurrect and reactivate their businesses, I think this is necessary for that particular purpose only. As regards the 30 plus or 60 plus, see, the thing is, we need to also ensure that there needed to be a kind of an indicator which sort of represented that the person was not inherently in a bit of a problem. So, the moment you start to expand that from 30 to 60, it will indicate that he already had an inherent problem even before the COVID struck. So that's not the intent of these programs that have been that has been unveiled by the Reserve Bank of India. I think their focus is to provide support, whether through liquidity support or by trying to alleviate the terms of payment over a slightly longer period of time as defined now. I think this is pertaining to people who have been particularly impacted by the COVID pandemic and the resultant lockdown. So my view, I mean, I could be wrong. I think even within the company, people could have multiple other views. I believe that 30 plus is appropriate. As regards what is going to be our thought process in terms of implementing this, I think we are very particular that we will choose this tool only as a kind of on a very judicious basis. We're not going to sort of, as we have seen even in the moratorium, we ensure and insist to correlate the kind of issues that a customer faces, whether it's on account of pandemic and whether he has a sustainable model to be able to come back to normalcy with this kind of a restructuring. Only then we are going to patronize that. Otherwise, we have taken a call that we will not do things which will in an indirect manner mean kicking the can down the road. The very fact that we have accelerated recognition of NPAs, I think the people on this call sort of appreciate that we will never have those kind of intentions to restructure only to provide some amount of relief for our financials. That we are not bothered. We are probably happy to even accelerate some more to prepone some of the recognition rather than postponing it down the road.
Got it. Thank you so much.
Thank you so much.
Thank you.
And your next question comes from the line of Sandeep Bapat from Hill House Capital. Sandeep, your line is now open.
Yeah, hi. Thanks for the call. Just one question on the moratorium book. I think on the earnings call, I think there was some commentary given on the salaried customer that 98% of them are getting their salaries. Was that comment for the overall sort of retail book, or was that for just unsecured? That's one. And then any commentary on the self-employed segment within retail and what's happening with that?
Shini, you want to take it or should I take it?
The 98% is for the overall retail book. Right? Anybody receiving salary credits, that is what that comment was.
Within moratorium, is it similar or is it very different?
Very similar, not very different. So the moratorium, as we described, in good amount of 90s, high 90s, the people who took moratorium have 0 days past due. Let's call it less than 30 days past due, if anything. High 90s. So that means people were not delinquent for 3 months or whatever, 2 months, 3 months, and taking moratorium. They all come pay up and say, give me moratorium, because at any point in time they want to conserve cash for the next 3-6 months with them and don't want to use it up to pay off. Though that is the kind of profile of customers' views that we had got at that time. Now, what was the second one?
DPD, sorry, just on that 30 DPD that you're saying, is this pre-COVID this is, or this is during the moratorium? That they are actually paying, but they are part of moratorium?
They have paid and then took moratorium. And so when you look at the moratorium book, you see that they are not more than 30 days.
Okay, understood.
They're either current
my second
customers
question
or less
was
than 30 days customers.
Understood. My second question was on self-employed. What's happening on self-employed within moratorium?
Self-employed, self-employed is, you're talking about the SME book or the unsecured personal book?
I'm talking about like the retail, whatever is retail and goes to self-employed. Right. So let's say a home loan or auto loan or a loan to like somebody who's a non-salaried customer.
Oh, okay. You take any kind of loans who are having any type of, not just unsecured, they're focusing on. Yeah, that's Is no different. If anything, it's at the similar level. There's no such kind of a bias between one versus the other. We haven't seen anything different on that book. Certainly, the self-employed have been slightly more impacted than the salary. But it is not off the page, is not off the mark in anything. I think we did talk about it, didn't we? In our call, we did give some details about that too.
Understood. Just one sort of last question. In terms of some banks have disclosed that 5-6% of their loan book on top of moratorium is an overdue bucket, where they haven't given moratorium, but they also haven't been able to collect. Do we have those kind of overdue pools, or whatever is not collected kind of gets into NPA or into the moratorium book?
See, there will always be something called the collection bucket, right? Which is what I had alluded to in terms of the collection resolution. That collection resolution bucket is the bucket which is not in moratorium, right? And has not paid on day zero. So it is in between. And that resolution is anywhere between 85 to 90% of the pre-COVID levels, despite certain key cities under various lockdowns in containment zones. Despite that, we are operating at about 85-90%, which we feel comfortable. From where even that overdue book and April. Yeah,
that overdue book would be created by the bounce. But even the overdue pool is not abnormally high. That pool itself is not very large.
Correct.
And then within that, you have 85-90% collection.
Correct. Yeah.
Okay. Understood. Perfect. Thank you.
Thank you so much.
So just to clarify, sorry, can I just add to what Srini is saying?
Yes, sir.
I think yeah. So you're right in terms of whatever you're trying to get at. Yes, we do have we've accelerated the recognition of NPA. There would be a residue portion in the collection bucket which probably may not be recovered or may not by the time the moratorium is over, or there could be a part of the moratorium book when it comes out of it, which even though we have a reasonable amount of good sort of comfort on the pre-COVID levels, post-COVID, we still have to examine how this particular book, the moratorium book, behaves. So some amount of incremental slippage is something that we will have to confront, and this is something that we've also spoken about in the past. Now, whether it is between today, currently, we are at 1.4, where will it sort of settle down after you have a far more clarity when we get out of the moratorium? Anywhere between 1.4 and 2%, which why 2%? Because that's what we had reached as a peak during our global financial crisis in our 25-year history. Somewhere around that, I think we are expecting, but more clarity will come in post 31st of August when you start to go and collect on the moratorium book as well. So, as Srini was mentioning, while the recognition may be slightly elevated, if at all, I mean, that is something, if we are able to manage the resolution and collection, I think that'll be wonderful. But the provisioning aspect of it, I think there is a fair amount of upfronting of provisions that Srini and team have done, thanks to the historical contingent and floating provisions that he was anyway catching, and the incremental floating contingent provisions or COVID provisions that he has been providing in March quarter and also in the June quarter. So all in all, I think we are expecting reasonable amount of stability, slight uptake in the NPLs, but from an overall credit cost, I think we should be more or less in line with whatever we had been doing in the past.
Thank you so much. And your next question comes from the line of Julian Welsty from Loomis Sayles. Your line is now open.
Thank you for the call today. I have two questions, actually. The first question is about the mobile app. So banks are continually adding features to their mobile apps. Can you talk about what features you are looking to add or working on adding now that you do not have at the moment? And the second question was about compliance. You recently conducted a review of your auto loan book, which I think found no inappropriate lending, but there was some inappropriate behavior by several people. Can you talk about whether you think your existing compliance was enough to capture that, or whether you are tightening compliance having reviewed that auto loan book?
Let me take the second question first, and then the first one on the mobile apps, I will let Anjani take that question. On the auto loan book, as I said, the auto loan book is it's a very well-built book. I don't think there is any problem on that book. However, sometime in late December of 2019, we did sort of receive some anonymous complaints on certain transgressions on some of the sales people or the frontline people getting some amount of gratification or transgressions from the dealers. So that is something that we investigated. Whilst there is and we sort of took action because of the personal misconduct of such people, we did sort of ask them to go. As regards the book itself, there's nothing wrong with the book. I think the bank acted in perfect compliance. We are proud that every complaint in the bank is sort of investigated and inquired at the highest levels as well. So even if there is a question mark on anyone, even the senior-most person, even he is also investigated or inquired. And we have taken appropriate actions on the people where there was circumstantial evidence of transgressions, of personal misconduct, and that is something that is out of the way. In terms of compliance, as I said, one can debate this as to whether did we offer this product. This is a product which goes as an accessory to a car. We fund the car of the customer. We also fund this particular device. Did we sort of receive any fees and commission processing fees? Yes, we did receive processing fees, but it's a very minuscule amount. And even from a lot of people have been talking about how much of is it that the entire auto loan customers have been forcefully sold these kind of accessories? Absolutely not. It's less than 5% of the total auto loans who would have got this kind of an accessory or a device. So it is not as bad as people have put out to be on the social media. Obviously, this has a bit of a put us on the back foot in terms of our reputation. We feel absolutely sad that this event had to occur. Yes, we are tightening our controls. We are tightening our code of conduct. We are communicating this, saying that we are a no-nonsense bank, and this is something that we will not tolerate. We have demonstrated that in action in terms of taking immediate actions, in terms of whatever that is required, in terms of asking people to go, or even holding back or clawing back some of the variable pay that they would have received as long as we have control over that. So that's the issue all about. We don't have any other issue in terms of, yes, there could be, some amount of risk that we would have taken in terms of the dealer funding, but that is also some amount of noise there has come about of that. There's nothing to worry about on that particular book as well. We are pretty much, because we do have a completely independent credit architecture in the vertical, which has no relationship with the business side of the activity. So they have, so no one from business can actually influence any credit decisions. Credit sanctions, yes, there could be calculated calls or risks, but if you really look at the actual loss experience in the dealer funding group book, it is extremely low as we speak. That's on the second part of the of your question. Anjani, can you talk about the first question in terms of on the apps? What are the things that you're planning to do in terms of making your app far more enriched vis-a-vis others?
Yes, indeed. So on the mobile app side, we are adding new things, new features, which is, we have three guiding principles around it. One, a lot of these origination journeys that we are building, for example, opening up new accounts, taking new liability products, new assets, new cards, etc., all those are going to start and finish online on mobile itself. So our customers can download, even if you are not a customer, you'll be able to download the app and start the journey. So that becomes the starting point of relationship with HDFC Bank. Number two, we still get a lot of service requests which go into branches and come to call centers. And based on the new requests which are coming in, we have prioritized the list of changes. And those will also figure in the mobile app as we go forward, so that those calls which are going into either branch banking or to virtual relationship channels can be offered to our customers on unassisted mode. And number three, we still have quite a few capabilities which are available on net banking, which is not available on mobile banking because of form factor constraints. We now have much more intuitive journeys, so that those same capabilities can be offered on mobile also. So therefore, net banking and mobile banking will be able to offer both all the capabilities on different form factors. So these are the three things which are going to drive our changes on the mobile app as we go forward.
One thing I want to mention, I think the operator, can you get the Parag back on the line? I think he dropped off.
Hi, he's back on the line now. Thank you.
Rahul, can we go on to the next question, please?
Yeah, hi, Sashi. Operator?
1 second, please. And your next question comes from the line of Sumit Agarwal from ICC Bank Treasury. Oh, sorry. 1 second. Next question comes from the line of Varish Jain from Bajaj Alliance. Your line is now open.
Yeah, good evening, everyone. Just to understand this moratorium thing, so is the understanding correct that out of 100 rupees of loan book, 9 rupees is under moratorium, and of the balance 91, the collection efficiency is around 85 to 90%?
Yes.
Hello?
Hello?
Yes,
that is right. Out of 100, 9 is on moratorium. On the balance, we are having a collection efficiency of, not on the balance of 91, on whatever is in the collection pool. Because you know that as you present on day 0, there is a level of collections that happen. And then whatever moves out of day 0 into the collection bucket, efficiency of 85 to 90%.
Okay. And how will this be across segments of retail and corporate?
This is more or less, this is all retail. Corporate is very negligible, I would say, in the overall scheme.
Okay. Okay. And when we are saying moratorium, the 9% of the book, that means only one payment is overdue, right? The 30
For
days
most part.
you're talking about.
For most part. That's why in the 90s we said that's only one.
Right. Perfect. Thanks a lot. Thank you and all the best.
Thank you.
Thank you so much. And your last question comes from the line of G2 Panjabi from EM Capital Advisors. Your line is now open.
Thanks, Sashi and team. Congratulations on the new role. So I've got three questions, right? Sashi, one, this whole digital 2.0 and the new HDFC Bank that we're going to see, is this going to be a competitive necessity, or is it going to be a significant part of the profit pool 3 or 5 years from now?
I think, number one is that this is, let's face it, today from a customer acquisition
Operator,
perspective...
can you get Parag again, please? Go ahead, Sashi. Parag dropped off,
Yeah. So, from a customer acquisition perspective today, Jitu, we rely on customers walking into our branch stores or onto the web stores or on net or mobile banking. This is a universe in which we try and capture our customers. And in some way or the other, we have digital marketing, which we sort of try and capture when people search on various platforms to be able to bring them on an unassisted basis into the fold. But what we realize is that here is an opportunity for us to ride, because we provide so much of traffic to a lot of partners, whether it's the e-commerce players or platforms, whether it's our corporates. We are the largest salary banker in the country today, or even as Parag was mentioning, even on offline merchants, there are large chains of merchants, wherein, probably I did mention also in the semi-urban rural, we have a fair amount of partnerships with business correspondents, such as the common service centers. So what we realize is that, partnering with such different players in the ecosystem outside of the bank is something that will expand our footprint to acquire more of the new-to-bank customers. So effectively, your question is absolutely right. It's not just only from a protecting us from a future threat, but also converting this into an opportunity in terms of how we can ramp up customer acquisition, and also because we are not sort of just acquiring customers, we are also going to be selling other products, so that we should be, as we have done in the past, I think we should see a significant amount of profit pool also emanating out of that.
Okay, great answer. The second question is, Aditya and you guys have built a superb business, a superb bank over the last, 25 years. And what I'm talking about is the cultural part of the bank. So the bank's culture, the competitive intensity, the processes, the systems, everything that's working like a machine. If you were to fast forward and say what legacy would Sashi want to leave behind? What stamp would he leave behind on the culture of HDFC Bank? What do you think the answer to that would be? I think culturally.
I think, you're right. Yeah, absolutely. I can tell you that. The thing is, a person like Mr. Puri is 1 in a billion. Okay, I don't think we can create such people going forward. It will be too naive for me to think that I can actually fill into his shoes. The fact that I've been fortunate and blessed enough to be on the ringside to watch him and absorb and imbibe some of the way he has set up this institution and this platform, I should be in a position, I'll be, as I have also maintained, first among equals to carry on the legacy. I would like to, because I don't want a situation wherein, I would like to be known that, okay, there is another person leaving, so there will be a further disruption. We want to leave a footprint saying that a platform which has been created for so well for over the 25 years, the next 25 years we should be invisible as people, as leaders, and we want to be known as just an invisible HDFC bank going on an auto roll or an autopilot basis going forward. That is what I would like to be known, and not as someone saying that, okay, this is a legacy he has left. I would like people to say that, okay, he has continued the legacy, and the team at HDFC Bank has continued and carried on and will continue going forward as well.
Brilliant. Okay. And the last one, filling in huge shoes that Aditya leaves behind. What's the one or two things that's going to be most difficult in filling in these shoes?
Yeah, see, the thing is, it's quite, and I can confess on that. I mean, he had the gravitas. I mean, for a person who became CEO of an MNC bank in Malaysia at the age of 36, look at the amount of 34 years of being a CEO. You have the ability to have, you can carry that kind of dominance in whether it's internal or even in the external world. So that is, I come in with that kind of an handicap. So effectively, my equations with my team is going to be completely different, because we were all peers at some point in time. I'm going to be first among equals. So that's going to be the winning that respect, which I know. I think a lot of people do we have mutual regard for each other. I think that should work. But yes, trying to demonstrate that and continue to take quick decisions is something going to be a testing time for me. And I think once I the first 90 days are very critical for me to move away from just being a part of the senior management to be a leader, to be able to demonstrate to myself, forget about anyone else, that yes, I can continue to do what he has been doing with Elan.
Very, very candid answers, Sashi. Good luck. You have our support, and look forward to seeing you soon. And best of luck with the new role. Keep well.
Thank you so much. Thank you very much.
Thank you so much. There were no further questions at this time. I will now hand over to Rahul Jain. Rahul, please go ahead.
Thanks, Sashi, Srini, Parag, Anjani, and Ajit for your time. You've been generous enough to take out 100 minutes on this evening. Once again, wish you very good luck. Very, very, comprehensive and great answers you gave out. And Sashi, on behalf of Goldman, once again, would like to extend, our heartiest congratulations and good luck for the next innings. Thanks a lot once again.
Thank you so much.
Thank you.
Thank you.
That does conclude our conference for today. Thank you for participating. You may all now disconnect.